you want to go and invest in government bonds, don't go there directly. Go through a unit trust. Because unit trusts, again, when you give them money, they pull together the public's money and then they invest it. And they normally invest it
at once
in government bonds. And because they're professionals, maybe they have the bargaining power. But the truth of the matter is, the Capital Markets Authority has no visibility in that market. And BOE, which is purporting to regulate that market, has a conflict of interest. Because world over, the problem in our bond market, these are things we take in the Auditor General. World over, a seller of a security or a bond or shares never oversees the safekeeping
of that.
And I've made this point before, even to people at Ministry of Finance. I told them, what you are actually requesting of the public is similar to going to Chiseka market, buying a banana and leaving it with the seller without any agreement on the safekeeping. If he gets a better price tomorrow, you may not find that banana. That is the arrangement in the bond market. So what we're trying to say is the safekeeping of the bond should not even be in BOU, because BOU has already been, actually BOU in this entire market is an agent. In the bond market, actually they are called treasury bonds, meaning they're issued by the treasury of the government. Yeah. Actually, the global practice is the treasury that wants to raise money, because they deal with the fiscal policy. And raising money for government purposes is fiscal policy, not monetary policy. Monetary policy in the bond market comes in the secondary market. That's where Bank of Uganda can buy also a BOU. Now you say it's another conflict. BOU can also come into the market as a buyer.
This is the Policy Digest, a Center for Policy Analysis podcast that explores how African societies are governed and how people and their leaders are shaping the future of their communities. Through candid conversations and insightful analysis, we aim to provide a deeper understanding of the political, economic, and social landscape of Africa. So sit back, relax, and get ready to explore the diverse and dynamic world of African governance.
Hello, my name is Joseph Tahinduka, and I'm the host of the Policy Digest podcast. And I hope that you've been loving the episodes that you've been watching, and go to all our podcasting sites. There's a lot of information that is not just surface deep, that touches on the issues that people rarely talk about, but still not at the surface. We go deep, and we go deep enough. In this episode, we are going to start to track and unpack the journey of the Capital Markets Authority Bill 2023, and it was an amendment bill of the version that happened in just the last decade. And my hope is that you can track this conversation, because it will spark a storyline on how bills start to be drafted, what happens in their drafting, what happens when they're at the committee stage, how do legislators think when they are coming up with these recommendations, that sometimes what is critical legislation. And in so doing, we are hosting one of the people that were quite involved in the drafting of the bill and in pushing for the same, who is none other than Louis Namwanje Kizito. You're most welcome to the podcast.
Welcome. Thank you for the invitation. Hope we have a good discussion today.
I hope so. So for the audience, just before Lewis comes in, Lewis has been a former general counsel at Pixan Tech, a powerful leading tech. He's a lawyer who graduated in 2018 from Makerere University and has a specialization in venture capital, in tech startups, banking, finance, and the law, and he's quite passionate about supporting the growth of the startup and tech ecosystem of Africa at the moment, and maybe he will tell us more. He's a partner at Pentagon Advocates. Is there anything I left out?
That's enough, really. That introduction is more than enough. People don't have people embedded with history of someone.
I know. I think that should be just enough. Maybe, when people hear things like capital markets, they may be like, let me just switch to the next episode. To help them, to ensure they don't switch to the next episode, can you try and break down what capital markets are to that ordinary person who is very interested in technical language?
Yeah, that is true. The bill is very technical, and that's why I sympathize with the members of parliament on the finance committee. But
Okay.
in some of these, they pass our laws, we have no choice. Because the bill has that language, let me tell you. Even master's degrees holder guys in finance can struggle with it. But let's get to it. Normally, capital markets, when we talk of capital markets, we are talking of an area where you can get money to do business. In Africa, and majorly in Uganda, when we want to money for a business, normally, in most cases, we go to a bank. So that bank will request for a security. Sometimes maybe they'll give you a salary loan, but salary loan, but for business, basically, they will want you to give a security, then they give you money, and then it's like a sort of mortgage. And so our source of funding primarily, actually, in Africa, and Uganda particularly, 99% of the money, that's according to the World Bank, that we want to do business, comes from banks. Now, that's a disadvantage because in other countries, there are other sources. Now, that's where capital markets come in. Now, the capital markets are an alternative source of money. And capital markets actually help fund businesses, but they have an angle of long-term patient capital. And for them, normally in capital markets, they rarely don't ask for security. Security is not a thing.
What approach do they take? How do they hedge that risk?
Now, for capital markets, they are broad. It's not, okay, it's an umbrella term, but they are too wide. Now, you will find private capital markets and public capital markets. Now, the public capital markets, that's where you see the stock exchanges, MTN listing and selling shares and to the public, and at a certain price they give you at, and your expectation as someone was given MTN money, the price of the shares will go up and maybe you sell, or you expect dividends, or you expect such benefit. But in exchange, when you go and buy shares in Uganda Securities Exchange, you actually go through your broker, who are normally licensed. A broker is someone who intermediates a transaction between you and the other person who is selling you something, like shares. So what happens is there is something called a depository where those records are kept. That depository is a different company from the Securities Exchange itself, and this is a global practice. Now, the depository, which is called the Security Central Depository, is a company that is supposed to be licensed by capital markets. So it's done that does the safekeeping for that record for neutrality, because the person who is selling you the shares, who is MTN, is not supposed to have control over that share.
Specific record.
Because in the olden day, when you bought shares before the digital age, you would actually take a share certificate back home as evidence of ownership in that company.
Ownership of that very asset, yes.
You will not leave it with MTN because, well, they can play with the record.
So at the moment, they keep the record themselves.
At the moment, the record is when they list on the stock exchange and they've finished the stages of the IPO, the record is actually kept by a separate company called a depository. So that in case you want to trade that thing, it is a depository that holds it. It holds that digital entry. So if you want to trade the shares, you deal with them more. MTN will get the money because that's what they want. But for you, it is your certificate of ownership that has just been digitalized to fit in that depository. Yeah? So that's public capital markets. You find stock exchanges. You'll find the public segment where, for instance, for you to offer any sort of shares to the public, it can even be any other security. I don't want to go into that language today. You're interfacing with the public. Now that is the public, where you find the stock exchanges, those public players. Now you also find private capital markets. Now private capital markets in Uganda, we see it more visibly in things like venture capital. Now venture capital gives you money for the kind of things a bank will not give you money for. For instance, a bank is not going to fund a startup on just an idea.
Oh yeah.
No, that risk is too high.
Yeah, sure.
Now, venture capital is risk capital, and it's a segment of another broader category called private equity. But for venture capital, an example is you have foreign incorporated domiciled venture capital funds that have funded companies like SafeBorder, Binusu, Insivuco, Cheaper Cash.
Oh yes, there have been a number of them.
There are quite a number, by the way. my friend at Imaisha Pay, most of these fintech companies, most of them, if you look at them, they are youthful people. Actually, even when you look at the big tech companies you have today, Facebook, Amazon,
they got off the ground.
Venture capital. And venture capital is in rounds, not a one-off. Unlike private equity, where someone just gives the person gives you money and you give him a certificate that he has bought shares in your company. This one is like in stages. It has different growth stages. Now, in capital markets, you have the public ones and the private ones. Now, private ones are not supposed to be ideally regulated unless they're going to interface with the public. And therefore, for a regulator to come into that space, he has to demonstrate that there is a risk is coming in
to mitigate.
Because it's a private arrangement. Between I have my company, I'm going to... But in other countries where they have sophisticated regulation, that's why the bill comes in. They've created a robust, like Mauritius, they have robust investment vehicles which these venture capital funds can take on. So what the authorities in those countries do, they create a good vehicle. Now, like in other countries, you have what the other vehicles they could which are very sophisticated, like a variable capital company, something. So in capital markets, you have private capital markets, and even the government also is a player in the capital markets, because when the government wants to borrow money to meet its budget needs, it issues something called a bond.
A bond.
A government
Do we have
bond.
some international, let's say, venture capital markets, maybe funds that participate in buying of those treasury bonds?
Yeah, actually, most of the people actually who buy government bonds are international. Ugandans, we buy them, but we're not the biggest buyers of them. You find people from the US, Kenya, actually even find pension funds, our equivalent of NSS. Actually, NSSF is the biggest buyer, one of government
of our
bond.
Government bonds.
Yeah, they invest in that bond to give the people, their members, a return, because bonds are normally safe investments, especially government bonds. The government is not going to default. But there are other risks that we shall discuss that you'll find in the bond market.
Sure.
But no, really, governments don't default. They don't default. But there are risks that we shall discuss. But the capital markets are also an alternative for government to issue what they call a government bond. A bond is an agreement to lend money to someone, but it has a fixed interest that you're supposed to get over time. So a bond can be structured in such a way that it matures in 5 years, but in those 5 years, you are getting an interest of say, 10%, 12%. And in capital markets also, you find investment opportunities like collective investment schemes. They've been making rounds all over the place.
Oh, yes.
So it's quite a broad thing, but the bill comes in to make that alternative of capital markets a viable option so that it grows and is domesticated much more, and the banks have, what you would call a competitor. But like we shall discuss, the bill is trying to give a regulatory framework for capital markets, which is suited for capital markets, not to bring banking logic and the way you regulate your banks into the capital. Now that has killed the capital markets. Now that's why we are coming, the bill, Honorable Nabita tabled it, because he felt and we felt that it was a private sector-led solution.
So we should not apply the same standards that
in banks
we're using banking. Maybe just since the conversation has started already, I was about to ask. So this specific bill that was being fronted, what specific problems was it seeking to deal with in the current capital markets of the nation?
I hope for the ordinary viewer out there, I've explained what capital markets are. And it has been
I really hope so.
clear.
As an ordinary person, I have gotten a free lecture.
I hope. Because,
You hope?
But one of the things that bill actually tries to rectify,
Yes, sure.
our capital markets have quite a number of, and you see, this is not a popular subject.
Oh, yes. So touchy day.
It's not popular, but it's important. You see, not everything that is popular is important. This is non-popular. It's not sensational, but it's actually...
But it's a fulcrum of the nation. People need to know how these things work, and
but because our politicians pass the laws, you are left with no choice, really.
to engage.
Yeah. So what the bill actually seeks to rectify is when you're going to... Actually, now we're dealing with... We know we have two licensed stock exchanges. Don't people know this? People know that we only have Uganda Securities Exchange.
Yes,
But there's another exchange called, I think, Altex. There are actually two. Altex, East Africa. So Uganda has two stock markets. Even you and I who are seated today here, we can say, we meet the requirements, let's set up a stock exchange. It's actually accepted in the law.
Oh, I didn't know about that.
It is. So it's a business. You say? So the stock exchanges have been crippled for some time. And like you and I know, the last companies that actually got onto the stock exchange by listing, a stock exchange is a place where you go to buy and sell shares. Uganda Securities Exchange is a very good example. The companies that have gone there for the past 3 years, they did what you call an IPO. An IPO is when you're going to offer your shares as a company for the first time to the public to get money. Those companies were actually forced by government. I should say it was a licensing requirement for you by UCC.
You had to list.
That MTN and Airtel had to list. So they did not go there because they wanted to.
Now, why was the government quite interested in ensuring that they list?
When you list on the stock exchange, your financial records become public. So you're not going to represent a picture to URA that is different from your shareholders.
I get you. The risk is too high. You can't play poker on too many people.
Certainly. So the stock exchanges are crippled. Part of the reason that the bill is trying to rectify and make the stock exchange more vibrant is bringing down the cost. For instance, when a company is going to list its shares or it's offer shares for the first time, there's a document they offer to the public to give them information, and that document is called a prospectus. That's a document that discloses all the company information, their expectations of growth, their financial statements, their management, their shareholders, how long they have been here, why they are raising the money, and what they are going to use it for. So all that document, all that information is in the prospectus. So that prospectus normally it is put together through someone called a transaction advisor, who is appointed by the company. It's normally a company specialized in that area. And there are, of course, certain lawyers. You cannot avoid us in certain transactions.
Oh, yeah.
Sadly, though people hate us so much, but you can't. So there are people who put together that document. And the reason why they do it through a transaction advisor is to create objectivity, so that the person who is selling the shares, who we call an issuer, is not biased. Now, the process of putting together that document is very expensive and cumbersome. And it is filled with contradictions. For instance, for you to actually put together that document, one, it has to be approved by the Capital Markets Authority. And the Capital Markets Authority charges you a fee,
to approve that document.
Which is a conflict of interest, because why should I pay you to approve something? But that's another discussion. So we all know the people who want to list shares on the stock exchange have to pay a fee to the Capital Markets Authority to approve that document. Now, that document, remember, it has already been approved and scrutinized by the stock exchange where the shares are going to list. And in our law already, even without amending it, if I'm going to list shares on the stock exchange, I actually, first of all, put together the prospectus. Then that prospectus is, first of all, scrutinized by the Securities Exchange where it's going to be listed. And then that Securities Exchange has already been given rules to follow by the Capital Markets Authority to approve that document. So after those rules have been followed in that document, they issue a document called a certificate of compliance.
Complying to?
With the rules,
Okay.
Any shares that are going to be listed on the stock exchange, they are given the rules. The stock exchange writes those rules, and then they are taken to the Capital Markets Authority for approval. So it's those rules you, as a stock exchange, are going to use to scrutinize and assess that prospectus. But what we're trying to cure is the contradiction. Now, if the Capital Markets Authority has already approved the rules for which I use to scrutinize that prospectus as a securities exchange, then what's the point in going back to the regulator and paying him 1.5 billion to approve the same document? So it's a contradiction, and it's bureaucracy.
It's a necessary bureaucracy. Well, what's the standard practice in other jurisdictions?
Now, like Honorable benchmarked with Mauritius, Kenya, but Kenya we didn't go so far because Kenya is still at our level. Kenya is also having some issues we're suffering from. But for the sake of benchmarking in the region, you had to. Kenya, Mauritius, I think you also went to the UK, you also went to South Africa. Now in South Africa, what we're proposing is not any different. Actually, in South Africa, when Honorable Nabita was benchmarking, they told him, on the issue of the prospectus, they asked him, He asked, actually, out of curiosity, how do you do the prospectus approvals here? Actually, the people at South Africa told him, at the Johannesburg Stock Exchange told him, absolutely not. Because if you subject a regulator to approve a prospectus, you imagine a scenario where you have 20 prospectuses. Will they be approved in time? No. And then the bureaucracy. And then they're not supposed to participate in those transactions. For them, their issue is, in case there's a problem, they can come in and mitigate it. But now here in Uganda, the Capital Markets Authority takes liability on itself. So if now, like Malema Bilizi, when there are issues in the prospectus of MTN, he went to court and for judicial review, something called judicial review in law, to review a decision of a public entity. But now, under normal circumstances, you're supposed to sue MTN, or if you don't want to sue MTN, you're supposed to complain to the CMA to come and help MTN mitigate or change something in his prospectus. But here you're forced to sue a person who has approved something, so he's not going to admit that he's wrong. So in other jurisdictions in South Africa, the stock exchanges, like Johannesburg Stock Exchange, they actually also have rules that they use to put together these documents. Then they approve, those rules are approved by the Financial Sector Conduct Authority in South Africa, and then it's those same rules that the Johannesburg Stock Exchange uses to scrutinize the prospectus, issue a certificate of compliance, and then, most importantly, you just file the document as to make it a public document. You file it with every regulator who is our equivalent of CMA. So world over, actually in the US, that's what they do. In the US, you never see the New York Stock Exchange or the Securities and Exchange Commission, which is our Capital Markets Authority, approving a prospectus. So what happens is the New York Stock Exchange has been given that authority to actually scrutinize the prospectus, approve it, and then they register that document with the regulator. So that in case I want it as a public record, the regulator has it. In case there is a problem, I tell the regulator they're lying here, the regulator can bring them to book. But here there's a conflict of interest. Once the CMA has actually taken on the liability, you know, it's interesting, even in the prospectus, the CMA actually puts a disclaimer and says, we have not taken liability for whatever we approved, but they have approved it. No, they actually say.
They're acting like a television station for these are the views of whatever the document is not ours yet.
But they have approved.
You said 1.5 billion.
MTN paid 1.315 billion.
And Airtel as well.
Airtel around the same amount. Everyone, that's what I'm
curious. What does that money do?
Those fees, well, that's part of non-tax revenue.
Oh, just like your ASB, they're charging you for Form 20, 50,000. So assuming it's 50, it's
So
okay.
In the broad area, if I'm to look at the stock exchange, that's the thing. And then we're also trying to fight what they call regulatory overreach. You see, our capital markets are still growing. The regulator should not have rules that are too tight that
as
the
if
industry
you
can't
have
grow.
like
and unnecessary rules.
like a world class.
Exactly. So what we want is a risk-based approach to overseeing the sector. What risk
maybe
is
just
there?
to give a bit of context, how does that overreach look like? Away from the fact that perhaps it's too much for just a nascent capital market.
Let me give you an example of what we have called regulatory overreach in the benchmarking report. For instance, there's a scenario recently where I told you there are two stock exchanges.
Oh, yes, sure.
The regulator has approved the rules for which you are going to function as a stock exchange. And in the event that he's not happy with the rules, he can tell you, okay, don't change them. Where the overreach comes in is you have put together a prospectus, you have given it to the regulator, and the regulator refuses to approve the prospectus in record time. It takes 3 years. There are scenarios where the regulator has actually taken 3 years to approve a document. That's regulatory overreach. Why? Why do you have to take 3 years to approve something for which you're supposed to do in a very short space of time?
What's that standard practice elsewhere? But 3 years is still too much.
It's a lot of time because these are businesses.
The sun and the moon.
These are businesses. They have timelines and they have goals, strategic goals.
3 years is
3
a
years.
lot. Yeah.
That's why we're saying the prospectus approval, much as the Capital Markets Authority needs to protect the public, they can do that. First of all, they exercise supervisory powers. They can come in every day and say, but we don't like how you're functioning. Yeah, change this, change that. But it's not good for them to take 3 years to approve a prospectus. And certainly, it is also not good. Now, overreach. Why overreach is also a problem is any regulator exists to mitigate a risk. That's why they exist. When you look at NEMA, when you look at CMA, BOU, they come in to mitigate a
A
risk.
specific risk on behalf of the public. Yeah.
But if you leave the risk and then you tell the people operating stock exchanges on even how to structure their businesses. For instance, someone has put together some good security called, I don't want to go into these things, but capital markets abroad, there's someone who put together something called an exchange traded fund. Now, most of you guys know about something called a unit trust. I don't know if you know about unit trust.
Yes, by
Old Mutual.
Most insurance companies. Yes.
They actually have that product offering. Now, a unit trust, if you get it and list on a stock exchange, it becomes an exchange traded fund. The way you guys are, people normally invest in, there's one interest in the market, but here is a regulator telling you how to structure your product, and yet you have already subjected that project to rules that he approved years before.
Yeah.
So it's my business. You get?
I have the leverage or the
and more so
freedom to
these companies that actually list on the stock exchange are customers of the stock exchange. So CMA can't go out of their way and deal with them directly. They have to deal with you, the stock exchange. We don't like how you're treating these guys. So that's how the overreach gets into you. You're not supposed to tell me how to structure a product. Also in a free market economy, you only come in when you have realized the risk and you have to mitigate the risk. And that's what IOSCO tells them. IOSCO is the International Organization for Securities Commission, which is like the UN of the industry. So these are standards we also benchmark
maybe just to in terms of the what you're describing as the overreach, they come in to have that kind of regulation, and their claim is that it is in public interest. Is in whose interest is it if it's not in public interest?
You see, any regulator comes in to safeguard public interest.
Yes.
Though recent, now one of the things that they are proposing in their areas for reform CMA, they actually, an example of overreach, just explain your question on public interest and overreach.
Oh yes, yeah.
In 2019, there is a product called an exchange traded fund, which I've just explained. It's like a unit trust, but for it lists on a securities exchange.
Oh yes.
That's the prospectus which they took 3 years to approve, but here it is. The regulator actually not only approved after 3 years, but when he approved it, it was a rejection. And then the person had to go to court, and then the courts had to tell the regulator that, but you did not even follow the rules that you approved to reject this document. That is overreach. So whose public interest are you then protecting? Now, they come in years later and say, we want to amend the law to actually deal away with these products in public interest. Now, public interest is a broad, vague term which is subject to certain standards. Is it lawful? Is it conscionable? Have you asked those questions? No. So the public interest
good in the question here.
The public interest they are protecting should be defined, and any public
it should not be
ambiguous, vague, stretched. So it's what we're trying to do actually in the bill is we're not trying to say the regulator should not regulate and protect investors. No, he actually should. That's why CMA exists. But how do you do it? Do you do it through over-regulating and stifling the industry and it's still at the same stage, or you actually grow you have risk-based supervision and regulation. You grow the industry as you're monitoring it. So for the stock exchanges broadly, that is what we are looking into. Now, the other more important thing that we're trying to deal with, we have issues in our government bond market. Now, the government bond market...
I wanted us to come to that, especially with regards to the Auditor General's report, where there were a number of issues that were cited with regards to how banks are participated in the bond market. Let's take just a short break, and in the next segment, we'll continue to that.
The Center for Policy Analysis is an independent think tank shaping parliamentary democracy, governance, and public policy in Uganda and beyond. Our mission is to shape public policy and strengthen democratic governance by delivering high-quality research, fostering collaboration, and empowering citizens. Our vision is a democratic society with transparent, accountable, and responsive governance systems. What sets CEPA apart? A unique consortium model that integrates expertise from diverse partners for multidisciplinary approaches. we pioneer thought leadership, leveraging tools like artificial intelligence to enhance impact. Through collaborative advocacy, we empower stakeholders to engage with legislative processes, all while combining rigorous research with a deep understanding of Uganda's political economy. Our flagship initiatives include Parliament Watch Uganda, that bridges the gap between the citizens and Parliament, the Policy Digest podcast that explores politics and public affairs across Africa, and the SEPA Convo, our bi-monthly X-Space tackling key public issues. Our work spans parliamentary democracy, human rights, public health, road safety, climate justice, artificial intelligence, and more, including the Africa Regional Conference on Parliament and Legislation. Join SEPA in shaping policies, amplifying voices, and building a democratic future. Visit www.sepa.or.ug to learn more or follow us on social media. The Center for Policy Analysis, a leading public policy think tank.
So the Auditor General's report did indicate that there's some issues with the bonds market that this bill also wants to respond to. Would you like to share a bit more context about that?
Yeah, that's true. In 2022, actually, that Auditor General's report of the year that ended in 2022, it highlighted discrepancies with the bond market, particularly dealing with the banks that actually are facilitating the public to enter into this market. The Auditor General's query was actually it was a licensing issue. The Auditor General queried why they call them primary market dealer banks. These are dealer banks. Now, in our capital markets laws, if you are dealing in securities are things in capital markets like shares, bonds, or securities. If you're dealing in securities, or you're going to deal, you're supposed to be licensed by the Capital Markets Authority. Unfortunately, these banks are appointed by the Bank of Uganda, and the criteria is not even very clear. But they after appointing them, they are not licensed by even the BOU, because BOU is also not a securities regulator, it's a banking regulator. It's not a capital markets regulator. So what happens is BOU picks out 8 banks. These 8 banks are responsible for selling people bonds on behalf of government, or you buy bonds through them. Or what happens is, now the bond market is structured like this. If you want to enter into the bond market and government has announced that they want to issue a bond to raise 5 billion, you go through a bank. That bank places an order at the Bank of Uganda environment, which is supposed to match sales and sellers and buyers, and that is how you get to invest. Or you send an email to the bank and the bank does the rest. Now the bank is doing an intermediary role for you. Now, if they're not licensed, what standards are you going to hold them to in terms of investor protection?
And what standards are they using?
We don't know them. That is now the problem that the bill actually tries to rectify. We don't know them. Because, one, we don't even know. For instance, if a bank mistreats you and you complain to Bank of Uganda and they are to help you,
Sure.
The truth of the matter is there are no legally binding laws that they will refer to and say, you have breached this is the punishment. You have mistreated an investor, or you have not executed the trading arrangement according to what the investor wanted. This is the rule. So without a license, you cannot hold them to any higher standards. So
it will be the same scenario of meeting someone on the street.
Exactly.
You engage in a trade with them and you can't hold them to account because they were not licensed.
Actually, even we want to help you to live by the goodness of their hearts. Because look, our bond market is funny. And we wrote to the Auditor General, actually, Honorable, we wrote to the Auditor General and responded to that query particularly. We told him, we're addressing this in the bill. We told him, you are right by saying that the primary bank dealer banks are not licensed. But the problem is more complicated than that. Because Bank of Uganda itself operates something called a depository. That's where they deposit the government bond investments that you and I have bought. Like I told you, in the olden days, when you bought a government bond or any capital markets product like a share, a bond, you would go back with your physical bond certificate and you take it home in your dressing room or wherever you keep your things. Or you give it to someone who has nothing to do with it, maybe a bank that is not involved, just for safekeeping in a safe. But in the digital age, ever since the 60s, we have now digitalized this, and we have created what they call securities depositories that do what you call the record safekeeping of these physical things. Now, BOU operates a depository, but under our current law, that depositories are supposed to be regulated by the Capital Markets Authority. Now, the Capital Markets Authority does not have visibility in that entire arrangement. What you are left with is Bank of Uganda, which is selling you the bond. It is doing the supervision for whatever it is safekeeping for you, and then it is regulating the entire space. So you have BOU as a regulator, as a seller of government bonds, and as a safekeeper of government bonds. And it follows standards we don't know to appoint people who are supposed to facilitate us
those specific transactions
in the bond market. When they mistreat the public through charging unfair fees, or they even fail to... Now, for instance...
or mistransacting, anything can go wrong. Yeah.
Recently, there was a scenario. You know, in the bond market, you have what they call the primary market and the secondary market. The primary market, that's when government has issued the bond for the first time and you want to get it directly. You go to your bank and the bank just gives you a form which is called a Security Central Depository form, and that form will be filed with BOE ideally. Then they would show that entry, because that depository, it's the depository, that's where the depository which does the safekeeping, the banks have to facilitate that account opening. That account is opened through the commercial banks, but that account which holds your certificate lies in Bank of Uganda, not the banks. The banks facilitate the process. Now, if you're going to go to the primary market, you go directly, the bank, and they'll file directly. The secondary market, that bond has already been issued.
Already it's out.
And it's in the depository already.
It's someone's asset already. Yes.
So you want to buy it from that person.
Are there people who primarily engage in the primary market for the purpose of selling to the secondary market?
Our secondary market is weak, and the reason why it's weak is because of this confusion, because you're not so sure if you buy it from some other person, the bank will offer a good price. Because it's not publicly traded like the stock exchange where you see prices are going up and down and like, prices are here, let me give you this. It is opaque. And most cases you may not even find a buyer, and then the only buyer you're left with, sometimes they may even hide the other buyers from you.
It's the bank.
And then it's a bank. Now there's a conflict of interest. You don't know if the bank is offering you a good price in the secondary market. So what people in Uganda do, they just buy the primary market and they wait for it to end, to mature in 5 years. If they bought a 5 years bond, it matures in 5 years, they get their money and go. The secondary market, if you get in there, actually what most financial analysts of late are advising is, if you want to go and invest in government bonds, don't go there directly. Go through a unit trust, because unit trusts, again, when you give them money, they pull together the public's money and then they invest it. And they normally invest in government bonds. And because they're professionals, maybe they have the bargaining power. But the truth of the matter is, the Capital Markets Authority has no visibility in that market. And BOE, which is purporting to regulate that market, has a conflict of interest. Because world over, the problem in our bond market, these are things we take in the Auditor General. World over, a seller of a security or a bond or shares never oversees the safekeeping
of
that.
Same, yeah.
And I've made this point before, even to people at Ministry of Finance. I told them, what you are actually requesting of the public is similar to going to Chiseka Market, buying a banana, and leaving it with the seller without any agreement on the safekeeping. If he gets a better price tomorrow, you may not find that banana. That is the arrangement in the bond market. So what we're trying to say is, the safekeeping of the bond should not even be in BOU, because BOU has already been, actually BOU in this entire market is an agent. In the bond market, actually they are called treasury bonds, meaning they're issued by the treasury the government.
Yeah.
Actually, the global practice is the treasury that wants to raise money, because they deal with the fiscal policy And raising money for government purposes is fiscal policy, not monetary policy. Monetary policy in the bond market comes in the secondary market. That's where Bank of Uganda can buy also a beer. Now you say it's another conflict. BAU can also come into the market as a buyer. But at some point, they're also the big seller. Now, let me tell you, okay, problem is these things are very deep and technical, but for me, let me just break it down to
the ordinary person, sure.
In the bond market, what we have and what the bill wants to deal with is, much as the banks are not licensed, we are trying to create the bond market and put it under the entire purview of the Capital Markets Authority. So that if government, the Treasury, issues a bond that I have to invest in and lend government money, that record is not kept and housed within
by the very person who
is selling me.
Yeah, sure.
It has to be kept somewhere. And let me even tell you another funny thing is, the other thing I'm trying to solve is, let me give you an example. Government bonds, Uganda Securities Exchange lists very many things. They list shares and bonds, but the bonds they list there's something called a corporate bond. A corporate bond is normally issued by a company that wants to raise money, but that's on the discussion for today. There's something called the treasury bonds are also actually listed. The government under Bank of Uganda, they actually go through the trouble of listing the bonds on Uganda Securities Exchange. But unlike Kenya and elsewhere, they are not traded and bought and sold at the Uganda Securities Exchange. What happens is they just list them there for the sake of showing that they're listed, but the actual buying and selling is within that environment, that depository of Bank of Uganda where they are kept. So you have two parallel questions, and you ask, if you're listing them here, why do they have to be traded in an arrangement which is
opaque, which is unclear?
It's unclear, and then even the safekeeping of the bonds doesn't make sense.
So your suggestion was that safekeeping should be done by an independent brokerage firm?
Yeah. Not even a brokerage firm. It can even be a government company, by the way. The government
or a private company.
Or a private company. But just for the sake of maybe, because world over, what's the practice? When you, let me give you a good example. When you hear that the dollar is a reserve asset, it doesn't mean that Bank of Uganda has stashes of dollars and sacks in its basement. Not necessarily. When they hear that, when they tell you that the government has bought dollars to put in its reserves, what it actually has are government bonds. US government bonds. So those are the assets that are kept in our reserve. So if government wants money, they just liquidate little by little. And maybe they can keep some dollars at hand, but they don't keep the entire $3 billion of what we have in US dollars in cash.
So which means Bank of Uganda, the way it keeps that kind of treasury is through buying a US bond from the US Treasury.
For instance, our reserves.
Say $2 billion.
The point I'm trying to drive about is the safekeeping, but I'm using an example of reserves.
Sure.
Now, when you buy a government, world over, we know the dollar is a reserve currency. But the reserve currency status of the dollar might rely primarily in the deep bond market of the US government. So what happens is the government of Uganda buys a bond, and the safekeeping is done by another company, not the Federal Reserve or the Central Bank of the US, not the Treasury of the US. It's done by a company called DTCC. All Euroclear. Let me give you a good example. You remember recently they froze the central bank assets of Russia?
Oh, yes.
They did not go to the Federal Reserve didn't have the record. Okay, they know the ledgers, but the people who they actually targeted, it's a depository called Euroclear. That's where they sanctioned. Actually, now
it was the digital repository of the bonds that Russia had.
Exactly. So the US government, the Treasury issues you the bond, but it is your asset. It has to be kept in a system that is independent of who has sold it. So that is why the European Union and the Western world, they targeted Euroclear and DTCC, and they froze the treasury bonds in dollars that the Russians held. So similarly,
the oligarchs.
The oligarchs. Okay, the oligarchs, that's private. I'm talking about the
actual Russian government assets, officially declared assets.
Because every government has reserves. Now, reserves have assets. Reserves have cash deposits. They have treasury bonds. Now, if you're going to buy a treasury bond from a government like the US, and you are going to keep it as part of your reserves, the US government may know that you bought it, but the actual record the actual certificate, if at all it was a digital representation, is not kept by the Federal Reserve, the Central Bank of the US. It's not kept by the Treasury. It's kept by an independent custody system, which is actually also regulated. The reason why it's regulated is because there's a lot of risk that comes with keeping those things and even trading them. Kenya, even, by the way, Kenya has a separate company called, I think, the National. It's National Security
government company.
Yeah, I think the governments have share. I think there's some government shareholders in that company.
So this specific bill was seeking to instate such a institution that is.
Mm-hmm. We're trying to say that if you have done the selling, the keeping of what you have sold is not your business because it's my asset. And because it's my asset and you're supposed to pay me back and you have people who are unlicensed, there is a risk in terms of I may not get a good price. Actually, the people who are the most disadvantaged in the bond market are you and me, not NSSF, not the big banks. And
at the moment, if I buy an MTN share, MTN keeps it.
No.
Who keeps it?
If you buy MTN, now let me give you, I've just given you an example. Before even MTN went to the stock market, and it was a private company. For instance, if you have a private company and you're selling shares in the private company, they give you a physical share certificate. Which you take back home. You don't leave it with MTN. That's the same logic. When you actually buy shares from MTN in the current digital age where it sits on the stock exchange, there is something called a securities central depository it's owned by the Uganda Securities Exchange, but it's a different company from the Uganda Securities Exchange. Now, when you go and want to buy shares through a broker, that broker is normally a member of that securities. Is like they call them a depository agent, like a member of that depository. That's where they facilitate.
They enable that transaction to happen.
So that record is kept in a stock exchange that is independent of both MTN and the Uganda Securities Exchange. So it's like its job is to do the safekeeping and transfer of these shares in case the need arises. What the Uganda Securities Exchange does, it just matches the order. It matches buyers and sellers. So what BOE does in our bond market, it is a seller, government bonds, but it is also matching buyers with itself. I don't know if you're getting the logic.
I get you.
Bank of Uganda is a physical agent.
There is a conflict of interest there.
Bank of Uganda is a physical agent of government in the bond market. So it's a seller. So in the normal markets, when you go to a market somewhere, a market is supposed to be a neutral place where you match the seller and a buyer. You get? In a neutral way. What you have in the bond market is BOU is a seller and it is matching itself with you, the seller. So you're at a disadvantage. Actually, in the bond market,
in a vulnerable position.
In the bond market, actually, one other thing that the bill is trying to rectify is there is no information. When was the last time you saw the daily prices of the bonds? The way Uganda Securities Exchange, they're going up and down. It's not.
You have to wait after 5 years.
You have to apply. No. If you want to do secondary trading, that information is very important because you need to know who is the buyer on the other side. How much is it offering? Are there better buyers? But sometimes you might get that information.
So the bill was requiring for some form of regular information.
When you regulate the bond market, CMA has standards in the public market that are supposed to be respected. Part of those standards are information access. You're supposed to get it. You get the banks are not licensed and they are under no obligation to give you this information. Even though you asked for it, you struggle. There are friends of mine who have invested in the bond market and getting information in that market is a problem. But anyway, that's just the bond market. That's a whole discussion we can have.
I get you, and it's quite huge. And I maybe to just make a comment or two. So when the bill came up, do you know how far it went with regards to these specific issues?
Well, we are having a meeting with the finance Minister of Finance tomorrow, but it's a harmonization meeting. The bill was actually...
The bill is not yet on the floor?
Not yet on the floor. The bill, the Honourable got leave of Parliament to table this bill in 2022, November 16th.
He's taken time.
Yeah. So, on 23rd May, of course, the clerk to Parliament wrote, through the Department of Legislative Services, they wrote to the Minister of Finance to ask for a certificate of course, the famous certificate of financial implication.
The infamous.
That one. Which certainly they denied.
They denied?
They did not give the certificate of financial implication, which for me I expected it anyway. Which they denied and don't give. And ever since then, we have been in a battle of negotiating, because now the Attorney General had to come in and write to Minister of Finance for the private member out about the bill and other stakeholders like Capital Markets Authority, the private players, actually majorly between the government entities and the private players to harmonize. So we had a meeting, a workshop on 15th August.
Okay.
We have another one tomorrow, the whole day. So we're going to be at Mestil Hotel. Tomorrow is Friday because this thing airs beyond tomorrow. So tomorrow we're going to have a harmonization meeting. Why harmonization? Because the Attorney General has been frustrating the Ministry of Finance's attempts to table a government capital markets authority bill. And his reasons are legitimate. He says the bill had just been amended in 2016 and 2011. So why this?
Why the rush? But the emerging realities, and maybe we should speak about them. So the other issue that was emerging was on the regulation of virtual assets.
Cryptocurrencies. Let's call them that.
Okay. Could you tell us more about how much of a problem it is and what remedies are being recommended by this specific legislation?
One, let me even shock the public. There is a blockchain. I'm going to explain these things. Today we are discussing technicalities. Dear listeners, forgive us.
We've tried our best, haven't we?
But we have tried.
We've tried
That's
our
what I'm
best.
saying. The members of parliament should really... I don't want to be in their shoes if I were to get the chance. But there is a blockchain... Virtual assets normally are built on blockchain technology. There's a blockchain intelligence company called Chainalysis.
Chainalysis, yes.
They made analysis on Uganda and they estimate that every 3 months, which is every quarter of the year, about $4 to $6 million worth of these assets called virtual assets, cryptocurrencies, come and are held by Ugandans. So there is a revenue potential even for URA there.
That's about 15 billion.
That's a lot of money.
That's a lot of money.
And I'm not going to mention the client. I had a client one day who told me, Louis, I'm going to bring in $3 million. I've just made money off Bitcoin, but I don't want to be taxed. So when banks give me a hard time, of course banks will give you a hard time. If you have never got $3 million on your account and you've been trading crypto and you're going to throw it on your central bank, of course Financial Intelligence Authority will ask.
But like, hey, where's this money? Actually, the meeting I was in, still meetings on a possible on cryptocurrency. I think CPS was trying to catalyze a conversation. One person said about land, like ordinary transactions here in Uganda using crypto.
And it's possible. So the emerging areas, virtual assets or cryptocurrencies, and virtual assets, when I say virtual assets, it is a broader category because virtual assets go beyond just what we know like cryptocurrencies. There are things like stable coins. There are things like custodians of these assets. There are things like tokenization of real world assets. It's a whole universe. So what are virtual assets? Just for the benefit of the viewer, because again, this is new territory.
Sure.
Now, in 2008, there was a global financial crisis. And it was, why did it happen? Because there are these financial intermediaries, like these global banks that were ripping off people and cooking the books. So a gentleman called Satoshi Nakamoto, who we do not know, came up with something
up
called...
to now.
No, we don't know. We don't know if it's a group of people, if it's a person. He came up with a white paper called Bitcoin, a peer-to-peer exchange system. And it ushered in this whole universe. So how are virtual assets built? There is something called blockchain technology. Now, blockchain technology is the underlying technology on which these virtual assets are built.
This crypto.
So when you have Bitcoin, it has an infrastructure of technology somewhere. When you have Ethereum, it has an infrastructure of Bitcoin somewhere. When someone has issued a token and he has tokenized a government bond for government to raise money, he has used blockchain. So it's the underlying platform, technology, enabler. How does it work? And in very simple terms, blockchain is like a ledger that accountants use. Only that this ledger is not centralized and in the hands of one person. A ledger simply records entries and exits in a business. If you have made money, what has gone out? I've made money, what has gone out? That's
credit, debit.
That's all it is.
Credit, debit, yeah.
This one is not centralized. It is decentralized in that you and I if we're in the blockchain and something is supposed to go on that blockchain, we're supposed to agree that that thing should be there. And on top of agreeing, once we put it there, it does not change. And on top of that, if it is there, it means that the nodes that all the you and I who are on
All
it,
the nodes that have the approved the ledgers, I don't know, are they like 1 million or 5, 6? All of them must agree to that specific transaction.
And it's transparent. So what happens is, the way you hear it, block, chain, block. So these ledgers generate a block. Once you finish a transaction, it enters a block. Then a block generates a chain, another block, chain. So what happens is, for that entry to get onto the blockchain ledger, distributed, it's actually distributed, it must have consensus, everyone around. For instance, let me give you a daily example. MTN has ledgers because it's a business, but its ledger is normally to it because that's a primary document. What happens is, if MTN is to leverage blockchain, it means that if it has shareholders, if it has customers,
every transaction has to be,
they have to be seen and approved by all the parties around. And then that's how it's generated as a blockchain asset, where it generates into a virtual asset. So, having explained blockchain technology and how these bitcoins are built in and how you can get a real world asset like a bond, you tokenize its entries on the blockchain and you distribute it. That is how it works. And in a very truncated, simple form, that's how a blockchain works. Now, why regulation? Let me shock you. I've just been reading the capital markets quarterly bulletin report. They say the accounts of people who are trading or who are invested in unit trusts has grown to now 91,000 people. The people who are holding these assets of virtual assets, the bitcoins, the ethereums, these tokenized USDTs, the stable coins, are 7 times that. So 400,000 Ugandans hold these assets. And by Ugandans, I don't mean, they may not all be Ugandans, but they are living within Uganda. 400,000
Ugandans.
Yeah. So it means there's a wallet that's hosted in Uganda that is a wallet. Now again, a wallet is a digital safekeeping of
these digital assets
that have been created. It's like your bank account for crypto. So you might find that a wallet in Uganda may be holding US and UK people's assets, but it's domiciled in Uganda. Don't you think that needs regulation? That is a bit. And let me give you a personal example.
12 billion. You said about $4 million US dollars. Yeah.
And let me give you, unless I'm not exaggerating anything. I'll even share the screenshot because I've shared it with people at Ministry of Finance before. How I got to know a client who wanted to, I don't know if they did, but wanted to bring in $3 million US dollars. That was in the first quarter of this year, in May, July. This client wanted to bring in $3 million US dollars. Now, $3 million US dollars is 20 times the turnover you ever get at Uganda Securities Exchange. And that's for everyone who has invested in Uganda Securities Exchange. Not everyone will make $3 million US dollars in a quarter. This is one person we're talking about. So even from a security risk, government should be interested.
From a money laundering perspective.
For money laundering, there is a semblance of guidelines, but they're not enough. Because for you to be a virtual asset service provider, you're supposed to be an accountable person. They amended the law in 2020. So the Anti-Money Laundering Act says that if you are a virtual asset service provider, register with them. They don't regulate you. They just make sure you have KYC requirements. But it's a disadvantage because for you to be an accountable person, you need a primary regulator. The same way banks have, the same way lawyers have, the same way accountants have a regulator. The same way insurance
companies. People will be vulnerable to quite a lot. And
so they are more effective fighting money laundering if there's a regulator, but FIA, Financial Intelligence Authority, comes in as a complementary ML counterpart. So
I totally agree with you, and I think this problem is huge. We need to have deeper conversations on it, because if there is something that's about 500,000 Ugandans are using, then it deserves regulation. And I, even if it was with regards to let's say a certificate of financial implication, such a regulator would raise resources locally using the mechanisms of regulation and maybe licensing or regulating that kind of market. Thank you so much, Louis, for sharing your perspectives on the need for this bill. I hope we have more conversations on the same.
But what we miss about the popular ones, the Ponzi schemes that are killing. But
those are obvious. We should regulate them. Those ones
should be banned, not even regulated. Ponzi, and the bill actually bans Ponzi schemes. Capture chicken. But the bill actually bans and creates penalties for operating. But
I really hope. I don't know when you hope this comes to the floor of Parliament.
No, the bill. My assessment is I think we may never have the bill on the floor. But it has achieved
some hope. You're having a session tomorrow. Are you going to that meeting with
what I think the bill has achieved
might never mature?
What I think the bill has achieved, the conversation has started. Because in the meeting we had last week, the other week, 15th, now Capital Markets Authority says they agree they should regulate virtual assets.
I saw you on Twitter saying Uganda Law Society was praying a
blind eye. Was defaming me.
But thank you. Maybe let's continue these conversations and let's have the conversation started. I think that's also very
it's
very
important. But the bill by itself, and I'm being honest here, I'm not being political. This is a very strategic area, capital markets, and any government really want a private members' bills.
I am hopeful whether it's within a year because I saw the government's legislative agenda. I didn't see the bill.
Well, the government legislative agenda, that's for government initiated bills.
And you know that government deliberately fights private members' bills.
Yeah. Even when however sensible, not like that bills. I don't think anyone can read through that bill and say this is crap entirely. No, but because it's like a vote of no confidence in certain people who are supposed to be initiating these things. So of course they have to make it hard. But for me, what I think that bill has achieved is some concessions because the CMA now have admitted to certain things in the meetings we have had with them, and so even when the bill is not tabled, at least it has initiated a discussion.
A conversation, and that conversation...
Not like the bond market. Now, recently the government set up a fixed income, bonds fall into the wide, I say capital markets abroad, the wider category of something called fixed income securities. You get? So the government set up something called the fixed income market committee to look into the chaos. But that conversation would have happened if
this conversation hadn't started. And I'm glad the conversation has started.
So the bill by itself, and I'm being very honest, though Honorable want me to say this, but it might not, and I've told him privately, it might not be tabled, which is not a problem.
But let's start the conversation.
But the conversation is important because next time government comes up with a bill, or even in the internal processes, some things will change. And now, like, for instance, the Auditor General coming up with such a hitting point, saying that, why are you not licensing primary market dealers? And then the private member picks it on and puts it in a bill. It means that even when the bill doesn't pass today or tabled tomorrow, in the long run, sanity can prevail. So that's the hope.
We sow the seeds for the future, I guess. Thank you so much, Lewis, for coming on this podcast and
thank you for the invitation.
Sharing that context.
Thank you for the complex discussions you've had. I'm sure it's the only complex discussion I have in a long time.
You've been deliberate about that, but yes, I'm hoping we can have other digital conversations on it as we had talked earlier. Thank you, our dear viewers, for being tuned into this conversation. I hope we've been quite charitable in sharing context about what's the spirit behind the Capital Markets Amendment Bill 2023 that is at the moment undergoing consultations before it can get to the floor of Parliament. Our hope is that you can share your perspectives just in the comment section. Access all our podcasts on all your favorite podcasting sites, whether it's on Spotify or Apple or Boomplay or Samsung. We look forward to walking this journey with you. Thank you.
Thank you for listening to the Policy Digest, a Center for Policy Analysis podcast that explores how African societies are governed and how people and their leaders are shaping the future of their communities. For more podcasts, check out our Podbean and YouTube platforms. Thank you.